when we look at Europe, it's hard to talk a lot about the data in the past just because things are so fluid. Things are progressing to the downside really very, very quickly. So we want to look at what the data is saying and then really what does that mean going forward and how that acceleration and what that acceleration is going to look like. So when you look at the S&P Global Eurozone Manufacturing PMI was expected at 49.7, came in at 49.6. PPI was expected to be up 3.7, came in at 4%. But when you start looking now with the loss of natural gas, you're starting to see more cuts. We expect that PPI, that side of things to continue to get worse. The question is how much worse, and that's that unknown. When you start looking at these pressure points, we still see a lot of downside for economic activity while you see PPI and a lot of these indicators really remaining and giving way to that stagflation. Eurozone Services PMI was expected at 50.2, came in at 49.8. Global Eurozone Composite PMI expected at 49.2, came in at 48.9. So when you look at it, you're firmly in contraction, and we expect to see that continue to come down, and we see more pressure to the downside. And that's where we see that the PMI is going to continue to deteriorate as, again, you have shuttered equipment, you have shuttered facilities, you have people who are laid off, and that's, again, going to put more pressure there. Investor confidence, not surprising, was expected to be at negative 26.8, came in at negative 31.8. We expect retail sales to continue to come down as you get, again, everyone getting pinched, because we keep talking about, especially in segment one, how you're getting facilities shuttering, both petchem, smelters, fertilizers, but those industries employ people. And if people are unemployed, are they going to be able to maintain their spending the same way? And that's where we see this accelerating to the downside. Now, Germany retail sales were expected to be minus 1%, minus 10 basis points in July, came in at up 1.9%. Manufacturing was expected to be at, August manufacturing was expected to be at 49.8, came in at 49.1. Exports came in at negative 2.1%. But if you remember, I've always said that imports are a leading indicator, and imports were expected to be up 0.4. Instead, they came in at negative 1.5. And that's where, again, we see the pain, we see the pressure coming through. Services PMI was expected at 48.2, came in at 47.7. German Composite was expected at 47.6, came in at 46.9. Factory orders accelerating to the downside. Industrial production, same thing. So again, it's just Germany is now on that slippery slope down. And the question is how fast? Does 46.9 give way to 37, or does it give way to 42? Now, just given how we're still in shoulder season, there's still natural gas in the storage, you're not going to get this massive drop off to the 30s. It's going to stay in that mid 40 range where you're still in contraction, you're still shrinking, but you haven't had that panic yet. You haven't had that real fear, which I think you can say the same about the market. You haven't had that capitulation. So France continues to be that kind of that flat line where global French manufacturing was expected at 49, came in at 50.6. Services was expected at 51, came in at 51.2. Putting composite at 50.4. So again, it's not, and this is the problem. France, Italy, Spain, other EU nations can't offset the German slowdown because France is flat. It's not really growing to offset or at the rate to offset Germany. Italy's shrinking, Spain's shrinking. You have Europe in general on a downward trajectory, and it's just accelerating now with more pain coming through on the natural gas side. The power side is going to stay a problem, and that's where we're going to get a lot of these industrial issues. Investors' confidence again dropped again. Retail sales slowing below pre-COVID trends. And that's where we see that acceleration, especially as people are sitting there and panicking about the winter. What is my electricity bill going to be? What is my natural gas going to be? And the problem is we're hearing all about price caps, and price caps don't work. Because if you're the industry producing it, and your upside is capped, even as your cost goes up, well, you're not going to produce because you're not going to make money. You're not going to be able to pay your employees. You're not going to be able to cover your fixed cost, let alone your variable cost. So why are you going to operate? And that's when you have exponential shortages, as we've seen in communist nations, as we've seen in socialist nations, as we've seen in the 70s with price caps. Like, there is nothing worse than a price ceiling. But again, here we are just, and again, and I'm sorry to say, and here, again, but when you look at the backdrop of history doesn't repeat itself, but it rhymes. Well, here we are. We're rhyming. We're reintroducing price caps in different ways, but no matter what, they never work. But I guess when in doubt, try it again. So yeah, it's going to be an interesting time. Composite outlook versus gross domestic product. So here you can see firmly negative, pulling down that product. Service business activity in Germany, again, the trend continues to deteriorate down. And it's something that's going to happen closer to that 2020 level where it comes down, it has a little bit of a flat line. We just think that after the flat line, you get that acceleration to the downside into year end. Eurozone manufacturing PMI, again, to the downside. Money data points to further falls in the PMI because you have the ECB, which has no choice but to continue to raise rates. So you're raising rates while all of this is happening because you're trying to get in front of inflation while doing price caps. Again, it's going to unwind so fast and going to be uncontrollable, which is when you get that capitulation and that pressure to the downside. Now, when you look at European manufacturing is in deep recession with forward-looking data sets like orders minus inventories at 2008 levels in Germany and Italy. This just isn't the environment where supply shocks will broaden out into generalized inflation, but you still have inputs and PPIs at those highs. You still have a significant amount of M1, M2 that has been floating there given the size of the ECB balance sheet. So if you were shrinking the balance sheet already like you should have been in 2021, there'd be some opportunity to do something or not have to do any raising now, but they're stuck. And that's why this is only going to get worse as they try to get in front of rates. And coming back to July, you can see the industrial production was fairly flat, but the construction PMI for August was 42.6, which just means that industrial production in August is coming down, and given everything that's happening in the market, is going to accelerate to the downside in September. Manufacturing orders, again, staying flat, but then consumer goods coming straight down. So the consumer's already feeling the pain, and given the shuttering of assets, the increase in prices, the loss of jobs, we just see all of this moving in the negative direction. So in general, we just don't have anything positive to say about Europe. The question is not going to be if, it's a matter of when, and it's a matter of how quickly. And typically the market moves fast, as they say, escalator up, elevator down. And that's what we expect to see in Europe. So in short, buckle up. But, as the ECB comes out, I think hawkish, it'll definitely, I think, shake people out who are expecting a bit more of a dovish commentary, which we just don't see. And that's, again, going to accelerate this to the downside. So that's what we have for you on Europe. In the next segment, we're going to cover more on China and what is happening on the Asian front.